So ready for buy and hold? You know, the best single investment that you can make in real estate is your own personal home. You can leverage more money when you purchase your own prime residence, but you also have some great tax advantages. For one thing, in the U.S., the federal government allows you to be able to deduct 100% of the interest paid on your mortgage payment. And by far, the lion's share of the money that you pay every month on your mortgage payment is interest. So that's 100% deductible, comes right off of your tax basis. Great opportunity. The tax advantages there. Another tax advantage you have, and that goes for any of your real estate owned, is depreciation. Now we know appreciation is a good word. Depreciation sounds kind of negative. But this is how it works. The U.S. government allows you to be able to depreciate the improved value of your real estate. In any piece of real estate, assuming we're talking about a home on a lot, let's say approximately 75% of that $100,000 property is depreciable. It's considered the improved value. In other words, the land is $25,000, the improved value, the structures on the site is $75,000. Over a period of time, it could be, depending, you know the rules change all the time, but it could be 18 and a half years, it could be 30 years. You're able to deduct dollar for dollar depreciation, the 75% of the improved value over that period of time and then prorate it. So depreciation is another exciting tax advantage to owning your own real estate. See, we're talking not about flipping properties now or wholesaling. We're talking about buy and hold. What advantage is there to you in holding onto a property? Clearly, in an up market, you go to bed at night, you wake up $500 richer. That's great. If it's in a stale market, that's another dichotomy altogether, and we'll address that in a moment. But there's another tax advantage to owning your own real estate. If you hold on to it, someday you're likely to sell that property. Now, the federal government in the U.S. charges you capital gains tax when you buy a property. If you sell it within 12 months, which is what a fix and flipper does, they have to pay 25% federal tax and any state tax consequence they have as well. But if it goes past 12 months, the current law is, well, that drops down to 15%. So holding onto property for at least 12 months is a good idea. You're going to save 40% of your federal income tax there. Okay? But another thing is if you decide to hold on to it as a rental for years and years, for decades, it's in the family, and someday it becomes fully depreciated, you decide, we're going to sell this property for whatever reason at all. And that's the beauty of real estate, is it can be so creative. There's so many variables, and they can all be used to your advantage, your family's personal wealth advantage. So you can defer the tax that you will have to pay, the capital gains tax upon the sale of that property at a profit, by doing what's called a Chapter 1031 exchange, tax-deferred exchange. This is a law that's been around, I believe it's in 1913. It's been around a long time, and it's not likely to leave. And the reason for that is that most of your lawmakers and legislators and those in the executive branch of the federal government all own real estate. See, 95% of the world's wealth has been created through some form of real estate holdings. Don't kid yourself, particularly in the U.S. So tax-deferred exchange, they've been around for a long time, 100 years, and they're likely to be around for a long time still. So you've got some great advantages in holding on to property from a tax standpoint. Now, the creativity standpoint is another great idea. You can rehab a property and you can rent it out. You can do a lot of things with it. You can do lease options. There are a number of really good exit strategies that make buying and holding a great advantage for you. You will, however, need some money down. Now, if, let's say, you're going to private money, which we referred to in a couple of principles ago, a couple of videos ago, you may need as much as 35% down to get that private money. So this is something that you'll likely do if you don't have the cash now. You'll likely do it as you assign a bunch of contracts as a wholesaler and then flip a few deals as a fix and flipper. And then you have a little nest egg where you can start investing into your own properties and keep them. Here is the key. Whether you're wholesaling, fixing and flipping, buying and holding, lease option, whatever it is, listen carefully, acquisition is the key. Knowing how to obtain a property cheaply enough so that you can make enough profit margin at the end, wherever your exit strategy takes you, that's the key. And in most cases, the techniques that you use to acquire property are going to be the same. So often you can decide on your exit strategy once you're actually into a deal. Another beautiful, creative opportunity that comes with real estate. Now, how do you negotiate these killer deals? That's what we're going to discuss next when we discuss human behavior in It's All About People.